There's always going to be challenges in any business, in any job that you do, but in a startup, you have to be able to really take hits because it's tough starting from zero. The chairman of the company, Terry Matthews, had given me a call and said that he had this great, exciting company that he wanted to tell me about. Just some great founders had started it up, really sharp people, so I thought, boy, that sounds like an excellent recipe for success.
The three founders, Mason, myself, Alicia, and Ronald, we all went to the University of Waterloo, and this idea of actually starting a company from scratch, straight out of school, was, I think, very appealing for us. And there was a real need and even a mandate for universities and colleges to have this type of solutions, ensuring that they have something if there was a crisis. As the company was maturing and we were actually going outside to seek more funding, especially from VCs and so on, we knew that we needed to bring on someone who has that experience, and Andrea fit that profile very, very well.
We were already revenue generating when I joined the company. So the founders did a great job of getting the product out quickly. It was customer focused, which is why they got revenue so early. And we said, we've already got quite a few customers and that list is expanding rapidly. We need an operations person. And that was the first management team hire that we brought on board.
Having Andrea meant that we always had a de facto decision maker. Instead of this kind of triumvirate, decision by committee, which occasionally does not actually produce a decision. So that helped a lot, I think, in the daily operational view of things.
One of the things that's really important in a startup environment is leveraging your network.
Being inside the Wesley Clover Venture Program, you get access to professionals that are here, and obviously having Terry as your chairman, you get just a lot of contacts into the wider ecosystem.
We all share lessons learned, we share successes. So even for someone like myself who's been through a few startups, it's extremely helpful and beneficial. The market's very dynamic, but particularly in a startup environment, in a growth market, it's extremely dynamic and things change very quickly. You're developing typically a new technology, and so sometimes things aren't always going to go right in the product development, and so you have to be able to quickly adjust and move in another direction.
We started out as emergency notification, but what we discovered in talking to a lot of customers is that once they have the solution, what really makes it cost effective is that they can use it for a variety of other notification things as well, because a lot of organizations are still using manual call trees, so you can imagine how much time is wasted.
We do have a product that is very differentiated. Our customers tell us that. So when people come to interview or look at joining or being a part of this company, they see that differentiator in the product. I get feedback unsolicited from people that I interact with, customers, partners, executives, etc., who just say that the team at Bembria is really great to work with. They're very responsive, they know what they're doing, and they just have an energy to get the job done.
As a small company, we can be very agile, and that is obviously one of the reasons why a customer would pick us versus perhaps a larger or more established company, is that we can be agile and we work with the customer to develop features and requirements, so it fits them a lot better.
What does keep me up at night is the fact that we do have such a big opportunity. Can we grow the business fast enough to really capture that? And are we doing all the right things fast enough to grow the company? It's a very exciting time. You're working very hard, and you need to be able to beat out the competition.
Every day there's a new challenge. You certainly would never ever get bored working at a startup, and it really, really stretches you to the utmost limits. The most recent one that we actually just launched last week was for a very, very big customer. We had to pull together a solution in a month. Usually when you're doing such a big project, you would have at least a few weeks of testing and so on, but no, it was right from that date. So it was a lot of overtime. We just did an update this morning where Mason was getting up at 4:30 in the morning to ensure the update went smoothly. I think we have just a great team here that we can pull together and make just these miracles happen on a daily basis.
The team is fantastic, very sharp people, very motivated, self-starters, and fun to work with, which is important in a startup. You have to be able to have fun.
The last big customer we won, we had kind of a half-day field party just out of the blue. We set up like volleyball net and had drinks and a picnic outside on the lawn.
And that just gets everybody energized again, ready to do the next customer, ready to do the next product release.
We're already international. We have customers in Australia and India, and we're pushing hard into UK and Europe and South America. So we are trying to be like the next Canadian success story.
So, good evening, ladies and gentlemen. Welcome back to Entrepreneurship 101. Tonight's lecture, one of our more popular topics, raising money. Before I introduce the moderator of tonight's panel, I do want to billboard an upcoming talk. We have a new Mars Capital series launching next Tuesday, the 26th, 4:30 down here. Title of this particular session is Building Successful Canadian Clean Tech Companies. This is we're doing this as an antidote to an events that we were at when there were a lot of US VCs who were telling companies, you got to go down to the States and move down there to be successful. While that is undeniably sometimes true, we want to showcase a number of Canadian companies, in this case clean tech companies, who were created and have grown quite successfully here, if for no other reason to show that you too can do that. So again, that's next Tuesday, 4:30 here, and you can get more information on the Mars website. So for tonight, I am delighted to welcome another colleague of mine, Barry Gekiere. Barry is the managing director of the Mars Investment Accelerator Fund, and by now, if you don't know about that, then shame on you. Barry has, I won't give the exact number of years of experience, many years of experience in a variety of management positions, both in venture capital and in operations. He has an HBA, business admin from University of Western Ontario. He has experience as a partner in private equity firms, and he served as a president in two turnaround situations, one an automotive parts company, where he grew the revenues fivefold, and the second as president of a publicly traded industrial holding company, where he undertook a turnaround of that venture. He, for over 12 years, was a partner at Ventures West, which is one of Canada's largest and longest-standing VC firms. He was a sector leader in their IT group, but he worked in companies in enterprise software, IT services, communications, clean tech, and medical devices. And I'm not entirely clear how clean tech and medical devices come under the IT group, but no one said VC funds work in exactly logical ways, I guess. So, as I say, he moved from there to Kirshner Private Capital Group, and he had a CEO assignment with an aerospace precision machining company. So pretty diverse range of expertise there, and we were really delighted to grab him to run the Investment Accelerator Fund, which you do know is an early stage seed fund investing in companies across a wide range of a full spectrum of opportunities here in Ontario. So, Barry, I'd like to ask you to come to the podium to introduce the other members of the panel.
Right, Tony, thank you very much for that introduction. Thank you for coming tonight as well. First of all, the panel is not quite as originally billed, but we think it's going to be possibly better. We don't want to tell Robin Axon and Rick Siegel that, who weren't able to make it, but we've got some great replacements for them on the panel. And I'm going to do a brief introduction and then let the panel tell you a little bit about what they're doing and the companies that they represent. Bryan Kerdman, right on my right, is a managing partner for Bryker Capital Corporation. I've known Bryan for a long time, and he's been involved, right now he's involved in angel investing in the technology sector within the GTA, but he spent the last 10 years with Edgestone Capital Partners, a very successful venture firm. And the notable investments that Bryan was involved with were WorkBrain, Protus, Slipstream, Ripple, and Vericent. Began his career, he's also an entrepreneur. He founded Bryker Data Systems at the age of 19 and built that up successfully and sold that company, and then went into the venture capital industry. So he has that VC and angel perspective that he'll be talking about tonight. So that's Bryan Kerdman. Next is Josh Sookman, who is replacing, stepping in for Rick Siegel. And Josh is currently the CEO at Gardley, which is I'll let him tell a little bit about his company as well, but it's a technology-based company that he started. And Josh was an analyst at BlackBerry Partners and RBC Ventures, and was doing due diligence and making investment recommendations there in the mobile space. Josh is a big supporter of the innovation and entrepreneurship community here, and he gets involved in judging competitions for business plans at universities, et cetera. Most notably, the Social E-Challenge competition at Stanford University, the Venture Capital Investment competition at MIT, and recently the Intel Challenge in Europe, where he was helped in judging there as well. So please welcome Josh. And then finally, filling in for Robin Axon, but Robin's partner actually at Mantella Ventures is Duncan Hill. And Duncan I know extremely well. Duncan was also an entrepreneur in residence at Ventures West for a number of years, worked very closely with Duncan. He was on the board of directors of RapidMine, which was acquired by Intel. He's an advisor on the board of Apollos, which was acquired by Microsoft. Serves on the board of Chango, which is an investee of Mantella, and also on the advisory boards of PushLife, which is a big recent success that was just sold to Google, one of their investments. Also Service Mesh, Serba, and Embotics. And Duncan is also a very successful entrepreneur and founder and chief technology officer of Think Dynamics, which was sold to IBM. So he's going to be able to bring that traditional VC background with Ventures West, also that new breed of VC that I would describe as Mantella, and then also a successful VC-backed entrepreneur as well. So there's our three panel members. And I'm going to ask Bryan to start and just give us a little bit of information about what he's doing on the angel side through Bryker. I'm not going to sit down.
Thank you. Bryker makes investments in information technology companies through two vehicles. One is indirect by finding fund managers. Right now we're invested in Georgian Partners, which is mid-stage investing Canada and the US, as well as the recently formed fund Class Capital, which does earlier stage, not pre-revenue, but sort of that $1 to $2 million range and needs growth capital. In addition to that, we do direct angel work where, and Barry always loves this, we have a fairly narrow criteria. We don't go west of Highway 427, we don't go east of Victoria Park. Pre-money valuation is $2 million or less, and the raise is never more than $1 million, and it's always in common shares so that we're aligned. And I say it, facetiously on the 427, if there's something a little west of that, fine, but our expertise is, and where we can help is in the GTA. We're not going to go to Calgary, we can't help there, and it's always information technology concerns regardless of the delivery vehicle.
Okay, thanks. Josh?
Yeah, so currently I'm at Gardley, and Gardley is a platform for emergency communication, but looking to change the way that personal safety is going to be delivered. So in the way that Ben Bria does mass communication, for schools and other organizations, we're looking to sort of flip that on its head and protect the person. So like a home alarm and monitoring system would protect you at home, or OnStar maybe in a car, what we're looking to do at Gardley is basically make you feel safe no matter where you are, delivered through mobile devices. And so today, our platform is on iPhone. We actually are in market for about 10 days now. We're building on BlackBerry and Android and Windows phones, so we're going to be across the board on mobile soon. And what we look to do as we evolve the company is open up our platform so that other products and services can leverage our infrastructure, which can do alerting and collaborating in real time by voice conference, by instant messaging, and by collaboration around map and location for both our users and for our responders.
Full disclosure, we're an investor in Gardley. So.
And I believe you also wanted me to give...
Just give a snapshot of the BlackBerry Fund and what their focus is.
So the BlackBerry Partners Fund is a $150 million fund focused in sort of mobile applications as well as infrastructure for mobile technologies. It was started in 2008, so it's a few years old. And I think they've made somewhere around 17 investments. Their typical investment, when I was back there, was around Series A, Series B was their sweet spot, looking to do about $2 to $5 million in an investment. But in recent conversations I've had with them, they are looking to do deals at the earlier stage as well. So a couple $100,000 at the earliest stage, and then obviously they would reserve and keep money for follow-on investments as they're looking to make bets as they go forward.
Thank you. Duncan.
Thanks, Barry. Mantella Venture Partners is a pretty new fund in Toronto. It's a $20 million early stage fund that we launched last March, so March of 2010. We very hands-on model. If you ask the CEOs that we work with, most of them would refer to us as co-founders with capital more than venture capitalists. But we are a fund. We do invest in companies. We have a slightly broader area than Bryan, but not dramatically so. We speak to companies in Waterloo. We have talked to companies as far afield as Montreal and Ottawa, but it would be hard for us to do deals there. Right now, all of our companies exist in our offices with us. We've got about 60 people in there right now, and not that every company has to move in with us, but we find that it works really well for them and works well for us, and none of them are wanting to get out yet. So, other than Push Life, who has to. We've done. We invest in software, cash-efficient businesses. We do, we get involved at the genesis stage of companies or a little later, but definitely pre-revenue. And we've done 4 investments to date and sold one, which was Push Life to Google 2 weeks ago. So that's Mantella Venture Partners.
Yeah, thank you. Congratulations on that, by the way. It's good for the industry. It's good for the industry as well. So speaking about the industry, it's changing pretty rapidly. I mean, Bryan, you were here last year as part of Edgestone, and now you're off doing your thing as an angel. How do you see the industry evolving, I guess? So where do you see the state of the industry right now? Where do you see it going over the next few years?
I don't see it improving a whole lot over the next 3 years, actually. The mindset now of the people who supply funds, such as Edgestone, with capital is they don't like the historical returns. The institutions are not there to create funds. There are a few funds being created. I told you a couple that recently invested in, and I'm continuing to look for those types of managers. But for people who are looking for a large number of opportunities to find capital, it's tough. In 2001, there were 55 groups in Canada looking for just information technology, not talking about environmental or clean tech or biotech. 55 groups writing checks, and there are less than 10 now that will do that. New entrants such as Duncan and Robin are in, but in and of themselves, they can do only a certain amount of opportunities. So the number of companies that will get funded will be sliced by 75% from this time 10 years ago.
And Duncan, just give us a little bit as to how you were successful in raising sort of capital with Mantella, and you mentioned capital efficient companies you're looking at. Is that the key that then, as far as sort of the new trend in VC that you see?
It certainly is for us. As a smaller fund in the grand scheme of things, we're not looking to invest in things that are more than likely going to need $10, $15, $20 million of capital put on top of ours unless it's a real runaway success. Otherwise we can't follow on, can't maintain a level of ownership that makes sense by the time the company has an outcome. But how it worked for us really was a lot of serendipity, to be honest. Robin and I got together and decided to do something we call Basecamp Partners, which was to just get out and start working with companies and self-fund it. And we got working with Push Life and Shango effectively as co-founders of those companies, and started building an infrastructure around it with an intent of trying to build something bigger out of that. And it was that we were just out doing it. We've created a portfolio, we built some infrastructure, some process around it that attracted the capital to us, and it was from non-institutional source. You know, it wasn't from the sources that most venture firms in Ontario have raised money for in the past. It was a commercial real estate family that was wanting to diversify their holdings and get into technology, and they found us. To be fair, we're never out on the street looking.
Yeah. For me, I mean, even with the Investment Accelerator Fund, what we're doing is we're being a bridge to I guess later stage traditional funding. And I guess the thing that keeps me awake in the Investment Accelerator Fund is being able to find that next stage of funding. I mean, it's very difficult. So if I'm now the entrepreneur that's out there looking for funds and trying to find somebody, Josh, how did you find your money for your fund? And or for your company, excuse me, and what, just some advice, like what do I do? Who do I call on? Do I hire an agent to help me out in this area? Like what's the best course of action?
So call Barry. That's what you want to do. So I mean, there's two questions there. First, I'd speak to the agent. So with regards to hiring an agent, there's upsides and downsides. So the upside is if you don't know many people in the financing space, be it VCs or angels, they can certainly help make introductions. However, the downside may be that you're not actually building and establishing those relationships yourself. And when you're raising financing, you really are creating strong relationships with, whether it's your angel or your VC. And you're going to have that relationship for a long time. So I wouldn't recommend agent as your first choice. I'd say that's more of a last choice if you had to pick. But in terms of where you can find VCs and angels, there's a lot of events that are happening around the city these days. And to put in a plug for the Startup Digest, I co-curate that with a friend of mine, Will Lamb. And what we do is we curate a list of all of the events that are going on in Toronto that are technology-based and focused and have to do with either building businesses, somewhat social media, but also financing. And there's a lot of evening events where one is Startup Drinks, one is Sprouter or Sprout Up, which is going on tonight after this event. There's a ton of them. And so we curate that list for you. And many of those events will actually have angels and VCs that come out to meet technology entrepreneurs. And just as you're looking to find people to finance your company, as you'll ask Duncan or ask Bryan, there's a lot of VCs looking to find exciting technology companies, right? So it's a two-way street there. And if you get out and you network and you try to build your relationships, it'll benefit you, and hopefully it'll also benefit these guys in finding some great entrepreneurs to back. So go look in your backyard, look at your community. There are government programs, IAF being one of them. Barry, maybe you could speak to some of the other government programs that are actually out here, but I know the government, between the FedDev and OCE, there's a few pools of capital that are really trying to push the boundaries for entrepreneurs and giving them access to early stage capital. There's some that are specific to educational institutions. So if you're at U of T or Waterloo or another computer science group, there may be access to funding in those programs that would bridge that next step into forming a company and commercializing that further.
Okay. Let me point out one thing though, that they're not going to try and find you, these groups. One of the things that impressed me about Josh is he was telling me about programs that had been approved 48 hours earlier and hadn't even hit my radar screen yet, and went through every single one, what the criteria were. We don't meet this, we do meet that. I was all excited because this is interest free. You can't be lazy. If you're lazy, you're dead.
Okay.
Thanks.
Yeah, I would just add on the agent piece, and if something comes to us where it's an agent looking for funding for their company, it's going way, way, way down on the priority list of looking at it. With early stage company, you're looking for a company that's got a founder, someone in there that's a pretty good hustler, and if they can't dig up some investors on their own, and if they can't sell their company on their own, it's not sounding too good to us from the team perspective right out of the gate.
But then how do I approach you? Do I have to have a very detailed business plan? Like how far do I have to be along before I can come knock on your door?
So from our perspective, I mean, we're very early stage. A detailed business plan would be probably full of a lot of lies and crap, to be perfectly honest. So no. Reaching us, again, say we're looking for someone with a little bit of hustle. I mean, if you're building a business, you're going to have to do some business development. If you you should probably be able to find somebody in your network or in the greater network that can refer you. Things coming to us through referral from somebody that we already know and trust are going to go to the top of the list. I mean, we will always take a meeting with someone referred to us. Short of that, you can reach out to us and send something to info@Mantella, but that's definitely going to be a bit further down the list because we've got a lot of people referring things to us. So that takes a lot of our time. Check your LinkedIn. If you've got advisors, chances are some of them know how to reach us. Again, go to the startup drinks, go to the sprout ups. You're going to find people that know us and can make an intro. So that's sort of an early BD test.
And ask successful entrepreneurs who were able to find money. So, Josh's name thing, how'd you get the money? And all it takes is one connection.
It's actually a pretty small and pretty tight community. If you can get inside of it, you'll get to the
right. And this is not
know.
being broadcast across Canada. It's not like we're addressing things in Halifax or Calgary or Vancouver. We're talking about Toronto here.
Yeah.
You don't need all 10 digits on two hands to figure out who might be able to finance this thing, or at least give you 6 degrees of separation to those people.
And so if I could tack one more thing on. So, one of the other questions was, what did you have to do to raise this money, right? And so I had to speak to, I'd say, 70 to 80 people to get this money, to find that one person who is willing to take the risk and take the lead, and then everyone comes after that. Once you have somebody that will commit, and you'll know when you have somebody commit, because people will tell you all sorts of things. Right, and you got to cut through it, and you got to find someone who's willing to be your reference, willing to back you up, willing to talk to all the other investors who may not be sure whether they want to invest, and tell them why they're going to invest. So you can find that person, and then after that, it's much easier to sell all the subsequent parties. And there's places you can go for that, like AngelList, for example, right? And that's a place where you can go and find other people that will join the round. You generally won't be able to find a lead there, but you may find others who will follow.
So I'm going to ask you, Bryan, and so I'm coming to you, and what are you looking for? What's your key criteria? Sort of the 3 top things that you look for in an investment opportunity.
Well, I have this hokey acronym that my former partners always hated, but I still use it. Looking to invest in a pest. And it's an acronym for people with passion, experience, speed, and smarts that I trust. And when we're looking at the angel level, that E isn't a capital E, it's a small e. It can be limited experience. Josh has not run a business before, but he has experience in the industry. He is a subject matter expert, so he fits those rules. I'm also completely disinterested in any lifestyle business where you can build up a business that's going to grow at 15-20%. It's great, and you're going to clip some coupons and be able to pay the mortgage, but 10 years from now it'll be an $8 million business. That is not a VC finance business. And one of the things I absolutely hate is the lies. And people they do business plans. I don't think they lie on purpose. No. But when they have these hockey stick numbers that never happen. There's one fund out of Waterloo. Tim Jackson runs Tech Capital Partners, and he has a dartboard. He throws dart every time somebody says these are conservative estimates. And so just come clean, because most of the people who are in the business now, and here's the problem with angels, by the way, is I don't think that I'm part of that category, is in some respects we get bored. We're not in the business that we used to be in, the operations. We're not working 16 hours a day, so we want to help too much. You want to watch that. Like, Josh has money from, was it a dozen? 8? It's only 8? Okay, 8 groups, and I'm hoping that none of those 8, including myself, are intrusive. Let him run his business, because if we were experts and young enough, that's what we would be doing, but we're not.
Now, Duncan, you take a little bit different tack, so you actually are working with the companies pretty closely. What are you looking for in those companies and you're investing in?
Yeah, at the early stage that we invest, we're looking for team. We often refer, in venture, you talk about deal flow. We talk about people flow, really. It's about finding great people. And some of the things we've invested in, the people came to us with a completely different idea. We spent some time with them, got a different tack. We liked the person. We wanted to work with them. We thought that they'd be able to be someone that we'd want to back as a person. We just had to get them behind the right idea. And so we're really looking for the people. This is something that's been floating around Twitter lately. I don't know who coined it, but to say, in this really early stage, you're looking for a team that's got a hustler and a hacker. You want somebody who can create stuff, prototype stuff really fast, and you need somebody, it can be the same person, and you need a hustler skill set, somebody who has that speed, who has that energy, who has an urgency, isn't afraid to ask for what they need, and is just constantly driving, is uncomfortable with their rate of progress at any point in time. It's never enough. So that's really what we're looking for, is that team. Now, we need to, either work together, or they need to come in with an idea or something that they're going to work on in a market that's got some good scope, that has a lot of room for growth. But at the end of the day, we're looking for that cash efficient way to enter a market with a lot of opportunity with a great team.
Good. So Josh, you get involved in some of the, you actually had to go out and pitch, you get involved in some of these business plan judging and contests and entrepreneurs coming forward, et cetera. What are the mistakes that you think entrepreneurs make, that sort of the three biggest things that, from a venture capital point of view, given your experience at BlackBerry, you'd say, that's not the kind of thing that you want to do in your pitch, in your presentation?
Right. Well, certainly within the dialogue, the one thing that you don't want to be is sort of pig-headed and unopen to suggestion or thought, because often it's a lot of people you're working with. They're going to contribute a lot of thoughts and ideas, and if you can't be open as an entrepreneur, I don't think any investor is going to want to work with you. Not that investors are going to want to control what you're going to do, but if you're not going to listen to what they have to say, I think that's going to be extremely problematic. Another problem is I don't think companies often do a good enough competitive analysis and go out there and see what competitors are doing. I think sometimes they get afraid by competitors, the fact that they're out there and they're stealing your revenue, right? But having a good pulse and a good beat on what your competition is doing is extremely important, and you should know your competitors and tell your potential investors why you're different and what your competitive differentiation is to everyone else out there. So I think that would be the second point. And the third, doing the financial projections is hard. And sometimes I think it is a bit tricky for certainly a first-time entrepreneur to do that exercise correctly, because on one side, they can be too conservative in approaching a lifestyle business that Bryan obviously doesn't want to invest in. And then on the other side of the equation, there's another business that's making $100 million in year 3, right? And unless you're Zynga, and a huge exception, that's probably not going to happen. So
what is the fine balance there? Because I'm going to ask Bryan this, because I've said it in meetings, and if they give you the hockey stick forecast, right, they're chastised for the hockey stick forecast. But if I don't give you an exciting forecast, then I'm viewed as being sort of too conservative and it's not going anywhere. So what's the answer? Like, what do I need to do? What's the most important thing in presenting my financial forecast to you?
Well, just a little bit of an extra answer to what Josh was saying. The honesty component is really so important, because 12, 13 years ago, investors, whether at the angel level or Series A, Series B, had 14 nanoseconds to say yes or no to some stupidly priced deal that was usually $1 million for each PowerPoint slide. And now we all have time to do our due diligence. So if you haven't done your competitive analysis, we'll have the time to do it for you. As far as the financial projections, what I like to see, and I think what most funds now have the time to look at, is building a model that has a sensitivity analysis. It says, we're going to charge each consumer $1.99 for this per month. Well, what happens if we only get 99 cents? What happens if we can move that price up? And then we can help do those financial projections before we're just decide how much to invest and at what valuation. And another thing that I don't know how Duncan feels about it, but most fund managers that I speak to hate it, is when the entrepreneur, the company, tell the investor what the valuation is. Again, maybe the pendulum has swung too far the other way, but the market is very, very efficient. If you have something really good, then the valuation will come. Don't say, look, we're raising $1 million on a pre-money valuation of 7, because most people will just turn away and walk.
Yeah, unless you've already got a lead investor and you're talking to a second, and they've already set a price. That you're absolutely right. I agree with that.
But and if you look at the Mantella fund, at what size? 20, right? 20. They only have to do 2-3 deals a year, maybe. Nobody's getting fired at Mantella or at Bryker or at any funds for not doing a deal. No,
that's true.
Yeah.
That's true.
And for me, and I always laugh because it is so hard to please a venture capitalist on the financial forecast side or what you're trying to do with your model. I think the key thing is that it has to be believable, and you really have to understand what's behind it, the assumptions behind it, and what the sensitivity analysis is. In other words, as Bryan was saying, if things are changing, then you have to be able to articulate that and show the VC that you've gone through that exercise.
Listen, one plug for what we do and what Duncan does is that these funds are run by people who ran businesses. So we were where many of you are now. I started Bryker with $1,000 in 1976. Think Dynamics was a pure startup, a very successful exit. We can empathize with what it takes to you hire a VP sales and that person turns out to be an idiot. And what do? Many funds 10, 15 years ago run by financial people only who've never been behind the desk and have never sweated out trying to make a payroll. That's, I think, the best type of investor you can get.
And
I agree. I mean, the one thing just about this, about the financial projections or anything else that you're going to put in a pitch or say to the investor at any stage, keep in mind, I mean, what you're working towards here is a marriage. It's not a prom date. Don't tell me what you think I want to hear in hopes that I'll forget that later or that maybe I'll change my mind. We're building a partnership, so I think we have to be very upfront and open and get alignment. And Robin and I talk about alignment a lot. And so if you've got if there's a lot of variance and sensitivity in the price or how quickly you think you can enter the market, just say, look, we don't know, but what we really want to see is that you've done some customer development, you've done something to understand that what you put in those numbers was not just it feels pretty good. You've talked to some customers, you've talked to your target market, you have an understanding of what the price may be for your product, you've got some understanding of how big that market might be and how quickly you might enter it with some good assumptions, and that you then have a plan to test it. What are you doing to get out there and to test it? Can you test it in some smaller scale in a way that we can then extrapolate over a short period of time? And then what are the key metrics that you're going to be watching to understand whether or not you're hitting that pace or not, and so that you can zig and zag as you need to in changing the way you're addressing the market very, very fast, not just get to the end of 6 months of being in market and go, well, we didn't hit it, and we're not really sure why, but maybe we just need to change the product or something. You really got to be plugged in. Yeah. So behind those financial projections needs to be a whole mechanism that's been well thought through. And if we can see that, the actual numbers and the projections, as long as we think you're entering a big market with lots of growth, are
because you're never going to hit those.
We'll
numbers
figure it out
anyway.
when we get there. We'll figure it out together. We're
It'll be
partners.
something different you're going to hit. You'll never hit the numbers that you've given.
We made 25 investments in 2 funds at Edgestone, and not one company came even close. Not one. And we had 9 very successful exits and it's your former partner Mark Skapinker at Brightspark who taught us this. That companies have to be able to zig and zag. You hit a brick wall, don't just die, bounce off of it, and you find a way around it.
So let me expand on that. And I'll ask Josh just because you have to zig and zag. So I'm an entrepreneur, and you maybe went through this yourself, and this is the biggest challenge. So I'm early stage, developing my business, and it's evolving, and I'm thinking, and it's changing. I think probably Push Life changed a lot from when they first came in the door to where they are now with Google. So if I'm that entrepreneur and I'm changing my business, how do I stay in front of the VC? Because right now, when I first come to them, they may not have an interest. They may look at you and say, well, it's not fully baked, it's not there. But you're evolving that. How do you stay in front of the VC? How do you then get them to buy on through that process?
Right. Well, I mean, depending on how much you're zigging and zagging, it may be the same business, in which case it may still be exciting or not exciting, or it may, change drastically, right? Maybe you've zagged down another path and you've found three customers that want to pilot what you're doing and have made some sort of commitment, right? And if you've made material progress down a path, even if it's not the same one, as long as you're able to have decent relationship management and keep the conversation alive, I think you'd agree that you've done what you're looking for them to do. You've done that customer development. You found people who are willing to pay for a product that you're building, even if it wasn't the initial one, and that may be at a point where it's now an exciting opportunity.
Yeah, I mean, with Ray Reddy at Push Life, with Chris Sikornik at Chango, we didn't invest in the ideas they came in the door with. We invested in Ray and Chris. At the end of the day, we back them, and as long as we still believe in them, we're going to see them through the zigs and the zags, and we're going to help them because we back them in the first place, and we believe that they're going to find a way out the other side and make something great of it. They had the hustle, they had the drive, they're hungry, they're smart, and they were always working towards something that made sense. And what was great about it, you know, Chango is an incredible story. I mean, that company is nailing it right now. And quite literally, in the time that we worked with them, we built 5 or 6 products. Like actually built, went to market with a test, figured out what wasn't going wrong. A couple of the products were a deviation off of, like a branch off of the product we had. A couple of them were complete restarts. I mean, that was over just a little over a year that we managed to do that many iterations and testing. And now the thing's killing it.
But if I'm evolving, Bryan, how do I stay in front of you? If you haven't made that commitment to me, can I come back to you? Can I continually come back to you to sort of tell you where I'm at in my process and get you interested?
Absolutely. The investors that you want to be dealing with are ones who are going to be open to speaking with you. Some of the most successful funds in the United States, they don't even look at a company until they've had like a 5-6 year relationship with them. I was at the annual general meeting for Georgian Partners today, and their big supplier of deals is Insight, which just raised $1.6 billion, I believe, Bessemer, Sequoia. So we don't have those in Canada, but I don't know of any fund managers that are so busy that they're not going to readdress something that you have, saying, I need a half hour to update you. Because the groups that have assembled capital, they're still looking for deals. They're looking for good deals.
Yeah, if you're someone who's, if the person's impressed you and just didn't have the right idea, didn't have it matured enough yet, hadn't done enough work, I want to hear, we try to keep those people close because they're going to come up with something.
Case study at Edstone, we turned down one entrepreneur, Dan Shimmerman, who's CEO of Verisant, turned him down 2 times or 3 times, I can't remember. Just kept coming back like this little irritating guy back until he proved, you know what, I'm right, I've got these revenues. Company last year in its 4th year did just under $30 million and has raised, I can't even remember, it's in around 25 or 30 or something like that.
So let me ask one last question, then we're going to open up to the audience. If I'm lucky enough to get your attention, so now I have the VC's attention or the angel's attention, and you're now coming to me with your terms and conditions and your valuation, how much can I negotiate? And what terms and conditions can I negotiate? What should I be doing there? Do I take a hard line on valuation? Are there certain conditions that I can negotiate, or are there things I can't? Like how much flexibility do I have?
So I think that's sort of a function of how many VCs you have interested or angels you have interested at the table. And to whatever degree you're able to run a parallel process and get multiple parties interested, it sort of comes down to the negotiating leverage, right? If you have five different funds that are interested in your deal, you're going to have more leverage. You're going to be able to negotiate a little bit better because if one doesn't work out so well, you have 4 others. Whereas if you're at the table with one VC and that's your sort of shot to growing your company, I think your negotiating leverage goes down substantially. And then it just comes down to, is this a fair deal? I mean, all the deals should be fair. It's not really a competition. It's, making sure that everyone at the end of the day walks away saying, this was fair, this is a relationship I want to create. So, is it the right people? That's sort of what you should be focused on. Not so much that you have to give away 30% or 40% of your company. And, that's just the way it works. There's a specific valuation that's set, and it's got to make you comfortable, and it's got to make them comfortable. And then all the terms that come thereafter, I mean, sure, you want to look at them and make sure that they're fair, and I would certainly get a lawyer, and if you don't know how they work, and make sure that you understand it. But I'd actually say speak to somebody who's raised money before you step into that room and have that conversation, because you should have a good understanding of what to expect, and so it won't actually scare you. Right? I mean, just get acquainted with the sorts of things that VCs can ask for. And if you go to nvca.com, it's the National Venture Capital Association in the US, they have examples of term sheets. So you can download that. You can become familiar with all the terms so that when VCs start talking about things like ratchets and participating shares and all that sort of stuff.
I haven't heard the term ratchet in a long time.
Right? So you just want to be familiar with the terms so that when they come out, first of all, you know what they mean. You don't get scared off by them, and you can properly assess whether or not it seems fair. So I don't know if you want to weigh in there.
I just want you to tell me what a ratchet is. I'm just kidding.
Go ahead.
Yeah. Go
Well, it also depends valuations in terms at what stage you're raising. So let's assume that 75% of you are out there looking for that first level of money that's going to come from angels at 250 to 500, maybe $1 million. If you do the math, and I had this discussion with some of Josh's other investors because there was a discrepancy between the bid and the ask, which on a percentage basis was large, but in real dollars it wasn't. And I encourage them to just get over it. If you're going to invest $100,000 in Josh's company at this valuation and it's a little higher, and he screws up, you're going to lose the same amount of money, right? And the upside is worth it. So, you know, our criteria, the pre-money never being higher than 2, we're not going to get fussed between $1.5 million and 1.7 or something. We're going to look at how much capital is going to be raised, what the dilution is. We always do it in common shares because it's complete alignment with the founders. Back in the Edgestone days, which was, you know, larger checks. I mean, the minimum was 2, and we went from 2 to 10. We never once benefited by having a preferred share. So even though we were sitting at the top of the food chain, if anything went wrong, we got the propeller heads who were actually running the business, and we can say, well, we get our money back first, and they say, screw you. No. So you have to redo it anyway. So at the angel level, we only do common shares, but other angels still will do preferred.
Bryan said something that's really important, and I think he said it earlier, is alignment. I think we've dealt with a number of entrepreneurs who focus so much on valuation in terms of the deal, and what they should really be focusing on in that conversation is making sure that we're aligned on our interests. You know, make sure that a good outcome for us is a good outcome for you at any point along the way. You know, there have absolutely been stories of, and it has happened, where, you know, people do in sort of the big venture days. Entrepreneurs do a deal with a big venture fund, and the venture fund has the ability to block them from being able to sell their company. And the venture fund's vision was, this is $1 billion or die. You know, for them, they're investing in 20, 30 companies. They're looking for the big wins. We don't take $50 million exits. That's not what we got into this
$50 million puts $12 million in each of the 2 founders' jeans. That's cool.
So here you get a 28-year-old founder that's going to walk away with $20 million or $12 million or something out of this $50 million deal, and the venture capitalist is going, no, that's not what we got into this for. Sorry, keep working. Now, there's a lot of reasons why that doesn't work, but it has actually been used. So I think it's really important you get alignment with your investors and make sure that, one, they're investing in your vision. I'm notorious for this. I sit down and I listen to an entrepreneur, and then I'm thinking of all the things I would do with it if it was my business, and then I get all excited about it, and I'm thinking, oh, I want to do this, and then at some point kind of realize, no, he's still over here. Make sure that the investor is actually investing in the vision that you really are strongly believing in, or that you can come together on that. Make sure that, you know, if a $30 million exit is something you'd want, that they're going to be happy with that. But part of that also means that you have to have alignment of interests, both being common shares, and the investor needs to be able to have enough ownership in the company that if they put their money to work for 2 years, and the entrepreneur is going to walk away with, you know, $10 million out of that $30 million deal or whatever it is, that the investor doesn't just sort of, after that 2 years, just get their money back. You know, It's got to work for both sides. It needs to be a situation where everyone looks at it when that offer comes in and says, look, you know, we're in it together. We're both common shares. We're both going to do this well off of it. What do you think? Do we keep going, or do we take this?
Yeah, my thing is, I agree. I think it's really it's not so much about the terms and conditions. If you get hung out with that, it's wrong. It's really the alignment. And I think it's
when you're falling back on stuff in the term sheet, that's when everything's failed and broken down in your relationship.
It's like a prenup. You never want to open it up.
You just don't want to be going to the prenup.
So I want to open it up to questions, because I want to get a sense of what you want, what you think is important. It's a great panel, and I want you to be able to ask some questions. So the mics are there. If you can do that, it's probably better to grab the mic, because then we can hear you, and also this is being recorded for future use, and then they can hear it as well. So here's. You can yell it out, and I'll repeat it.
Fire it out.
Stay us with the business that's high capex, say the clean tech industry. As you're putting all the little project together, kind of taking on Ontario's industry, what kind of sweat equity can you expect to reasonably have? If you have, say, an 80 to 20 debt ratio, if you say I want to keep the majority share of this business? Is that reasonable to say when you have some people coming in as partners? Say you put a year into it.
Well, we're not clean tech guys. Last I looked at Duncan.
But just to answer that question, but just even on the capital side, you're saying you put a year in, you put sort of a year of sweat equity in. There's going to be a fair amount of capital being raised here that's going to dilute you. What's a reasonable ownership position for that sweat equity coming in?
Exactly.
Okay.
Well, I can only refer back to my Edgestone days because we had sister funds. We had the venture fund, which I was responsible for. We also had the buyout fund, mezzanine fund. On the buyout side, typically when there was a large amount of capex and the founder entrepreneur came with that idea, there was anywhere from 15 to 20%, call it free equity, on the initial funding. And that was a great exercise in trying to figure out what that first check should be. I can't speak to what the capex would be on your clean tech operation, whether it would be 2 million, 5 million, or 10 million.
I was going to say the same, that again, I don't think you're not going to maintain control of your business if there's a lot of capital coming in, and again, you've got a much higher opportunity normally. But I think the owners and the team have to have that 20 to 25% stake in the business at an early stage, and continue to try to keep that either through some kind of ESOP, et cetera. So that's sort of the rule of thumb, I think.
So I'm gonna add one point. So I had the honor of doing a 4-month internship at BDC Venture Capital with their life sciences group, and biotech has some similarities with clean tech in that the time horizon to an exit or to revenues is a significantly long time. And the way that a lot of companies are valued in the biotech space are through different phases or inflection points. So if you know that you've gotten your company to a certain inflection point that can be compared to other companies in the industry, and you look at how much they've raised and you have some insights into those deals and how much their founders were able to maintain, you can look at that as comparables, right? And you can walk into an investment shop and say, look, other deals, other companies that are at this stage have been valued at X, and for that reason I believe I should get Y.
Okay. Question?
I know as VCs you see a lot of the competition, but as entrepreneurs, you don't necessarily have access to the same amount of vision in terms of competition. So I was wondering, how do you find out who your competition is?
I think it kind of depends on your business a little bit, where you'd start with that. The one thing I think is important to recognize is that your competition isn't just other companies whose marketing sounds like yours. Your competition is what is the whoever's problem you're solving. What are they doing today? How else might they spend the money that you need to get in order to to pay for your product? Where's that budget going today? So yeah, I think you have to take a pretty holistic view of it, not just look at that. So understanding your customers first and foremost is extremely important in understanding what your competition is, because sometimes your toughest competition aren't the other companies that look like you. From my perspective, then it's again, depending on your industry, what are the various different blogs, other venture fund portfolios. It's groundwork on the internet and Google and digging to find those companies that sound like you. But I think that sometimes they may not even be your toughest competition.
This Mike here.
I'm not sure if this is like a stupid question, but I just wanted to know if investors are considered co-owners of a business, and also how do they assess the risk before they invest, and if a business is losing money, can they pull their money out anytime?
Wow. Well, certainly investors are depending on there's lots of different forms of investment. So if we're talking equity investment, which is what venture capitalists generally do, then they're co-owners of your business, yes. Typically, again, with equity investments, they can't pull their money out any time. There has been particularly in a lot of the angels down in the US, there's been a lot of convertible debt that's been happening, and sometimes those, I've seen a couple convertible debt term sheets that are callable. So you got to be careful with that. Convertible debt, they're not necessarily owners of your business until they convert, but they have the ability to become owners of your business. So I'm not sure if I'm answering the whole question. Maybe Bryan, do you have anything to add? Or
no, there was one celebrated case years ago that became a verb. that if you got your money pulled, this is what happened to you, what happened to this company. But nowadays, again, if you're looking at the early stage, you're going to get mostly equity investments because the convertible debt that's going to go in is it's going to be spent long before anybody can figure out how to get part of it back.
Yeah.
It's usually spent. There's nothing to pull out. They're going to give you the capital. They're going to give you a chance to work with that capital, and then you got a chance to succeed or not. But then there's really nothing left to pull out in most cases.
And it can get even more complicated. It could be secured by your intellectual property, and what's that necessarily worth? And, the easiest way to avoid the problems is to actually execute on what you said. And then sometimes, obviously, there's failures, but certainly all the angels that I participate with know that it's risk capital and know that the downside is 100%, that you can lose the money. The one thing that we take great solace in is that in a company like Josh's, even though the investors will arguably lose more money than will Josh if it doesn't work, he loses more because he loses time, he loses career opportunities, and he has to face all the angels and say, it didn't work. But we're big boys and girls.
Oh, could I just ask one last thing, because it puzzled me? You remember when Martha Stewart went to jail because she pulled her money out from an insider tip? Mm-hmm. Was she a shareholder, an investor, or why did that happen to her?
If I recall, she went to jail for lying about what she did. But she had taken a tip in a company that she was just a shareholder in, or decided to buy based on that insider information, which is illegal under SEC rules. And then when she was asked about it, she committed perjury, and that's why she went to jail, which netted her about $100 million afterwards in publicity.
Next question.
Hi, thanks for being here. I'm Carrie Ann Thomas. I co-founded a company about 2 years ago in media and communications. We've earned so far about $10,000, so it's something, but we're getting there. My question basically is, with the media component, we're service and publishing, and we're finding the need to now merge with technology, since that is the future. My problem is trusting people who I go to get them on board with me, because many of the ideas I bring to them get taken. So they might say no, or they don't get back to me, but I'll turn on the TV and see a commercial I told somebody, or I'll read the newspaper and see some of the ideas that I just candidly told over a conversation. So when you're going to venture capitalists, and a lot of people don't want to see you unless you can give them some information on what you want to talk about. And they don't want it general, they want it specific. So how did you prevent this from happening, even with disclosure agreements, where you can still keep your intellectual property?
Venture capital, if a venture capital firm were to, generally venture capital firms don't sign non-disclosure agreements. But if they were to get into the practice, or even once, exploit information they got from a founder that was coming in and pitching them their business in that sort of inappropriate way, I don't imagine they would be very well received beyond that. So I just don't, it just isn't done.
I've been venture investor since 1987, and there are a lot of firms in existence, ones that are no longer in existence that I could have a lot of negative things to say about, but I've never run into a case where somebody would have stolen an idea and then tried to launch it. Certainly not in Canada.
Well, in my case, that's happened, which is why I'm asking, how do
with
you
a venture
protect-
investor?
But
No, not with
with
a
the
venture
business,
capitalist, but
Yeah.
now that I'm going to be going to them, I'm a little scared now,
Yeah.
because
Don't worry
the other
about the-
people I
No,
went
we're okay,
to-
guys. The same pest rule that I was telling you about. You have to reverse that and make sure that you trust the people that you're dealing with. Because there's a lot of you screw up one deal and you're never going to get any deal flow.
But the key thing is you have to take it to, I would say, to accredited venture capital. You have to do some references. You have to know that they've made some investments. They've been around. If it's just Joe Smith and he's a first-time person and saying I'm a new VC, then you have to be a little bit cautious.
But not every idea, not every approach is financeable from venture capitalists. If it doesn't have unique intellectual property, it doesn't have a unique delivery model, if it's an idea that can be replicated easy enough, then there's no barrier to entry, and most investors will say no.
If you're speaking to an angel that's in your industry that has made money there and still is operating businesses there, you probably just want to, assess the risk that you're taking with that person. But if they're just a financer that's not in your industry, it just doesn't seem likely.
I just
So-
have one more question, which
No,
align with that. Just one more question. So When it comes to the venture capitalists, what if I wanted to actually host a session to bring the venture capitalists in to review the business, where they have an option to actually either bid in or say they want in within this company or any other companies I'm affiliated with? How would I do that? So I want to host a series of venture capitalists, say, I think we have a few businesses you might be interested in. Are you available this time to come down, be part of a conference or something, and be presented different businesses?
I've actually never been involved in that sort of approach before. I think typically what you find is, get a referral to the venture capitalist and go see them.
Yeah, I don't think they would show up for that kind of sort of dog and pony show, I guess, or that kind of pitch. Question?
Yeah.
Hi guys, I'm hoping you can help give us some tips on how to differentiate by the various, I'll call them generations of investors now. I'm seeing angel investors that range from friends and family through things like Golden Horseshoe Fund or Golden Horseshoe Ventures up to York Angels. And I saw a term sheet last week that from an angel group that made it very difficult to differentiate between them and a venture capitalist, except for they don't have a fund behind them specifically. And I was wondering if you could share any insights into what you see, because we're seeing all the way from Duncan's company, which seems to be very angel-like in a VC, where you've got Bryker is pure angel and has had experience in the VC world.
Well, I can take that initially. The groups of angels getting together are going up market and hitting the lower end of what traditional venture capitalists would have done a few years ago, and that's because every vacuum will get filled. So there aren't enough pure venture capitalists willing to write checks between 2 and 10, so you get angels that'll move up and do those 2 or 3. The problem in dealing with that level of angel is they have no capacity to follow on. One of the advantages of dealing with a Mantella is they may write, and I don't want to speak, I don't know what the numbers are, but they might write an initial check for $1 million, and they've got capital behind them, and if they like it, they can follow on, because that's your best investor. 99% of angels don't write a second check, whether they're singular or in a group. So it's your first check, and then you've got to be successful enough to attract that next level. I don't know if that answered your question.
Insight. Yeah. I don't know if there's anybody else has any thoughts, whether raising money or from Mantella's perspective.
So, I think from the term sheets you're seeing, some of the angels are getting more sophisticated in their term sheets, and a lot of venture groups like us, we're doing common share deals, which was not traditional before for venture. So they probably are starting to look more similar in that respect, I can imagine.
So unfortunately, I'm going to have to, what I would like to do, I think the panel here is willing to sort of hang back for a few minutes and answer some of the other questions of the people that are still at the microphone. We're going to have to cut it off because we do have a fairly strict time limit here. I want to really thank this panel of VCs and entrepreneurs, and for Josh, Bryan, and Duncan, because I think this is really the new breed of venture capital. I've been in the venture capital industry a long time, and venture capital was run by a lot of, I would say, more financial types that would look at more the finance side of it. And it's really shifting to entrepreneurs who have been there, done it before, and they really understand what you as entrepreneurs are looking for. And there's a great commitment. So I look at all the new funds that have been started, and Georgian Partners is another good example where there's been a successful entrepreneur who's come into the business, and I think it's great for venture capital. So I'll answer my own question where I think venture capital is going. I think that venture capital has been a very, very tough sector. Hasn't been a lot of capital available. I think it's groups like this and teams like this that are going to rejuvenate it, where you're going to see super angel investors that are coming back into this market. You're going to see boutique shops coming back in, focused on the entrepreneur. And we're starting to see some wins. We've had Push Life acquired by Google. Radian 6 was just acquired by Salesforce.com recently. And as we see these successes, it'll drive more success and more capital coming into the business. So my prediction is 3 years from now, this is going to be a very exciting panel, because you're going to see a lot more money flowing back into this industry. I think there's a lot of bright people out there that are going to really drive great businesses. And from the Investment Accelerator Fund's point of view, we're looking for those companies to sort of help work with and commercialize, and then take them to VCs that are then going to continue to work with these companies and grow them. So I see some good things happening. And guys, if you're willing, hopefully you'll answer some few more questions directly, but we'd like to thank everybody for coming, and thank you very much.